Hey, hi everyone. Welcome to another video in our positional options trading strategies in Indian index markets adjustments. Okay, so today we are going to go through the adjustments that could be done for reverse Jade positional strategy and in Indian index markets, and we will go through various scenarios and examples which relates to Nifty, Sensex, and Bank Nifty for each adjustment that could be done for this reverse Jade lizard strategy. Okay, so what is the reverse Jade lizard strategy? It is a credit strategy, and it is designed for a bearish to neutral outlook. And it's opposite of a Jade lizard strategy, where you have a neutral to bullish outlook. So here, what we will do is sell a call or short a call, OTM call, and we will short a put vertical spread. So you'll sell a put and buy a lower strike put. So that's what you will do. The goal of this strategy is to collect premium with no downside risk if credit is greater than put spread width. And view is expecting market to stay below the short call strike. So the below this short call strike, but not to crash heavily. So key feature is if total credit collected is greater than width of put spread, there is no risk on downside, only upside risk excess. So this is how a positional reverse Jade lizard strategy looks like. I have taken it for the 28th October. So here you would sell a call and you will then sell a put and buy a put. That's what you will do here. And your view is that market is going to be below 25,700. And so here, okay, and you'll get some leeway here. So you'll get till 25,980. That's what it is. And you will have no downside risk. Only if the market goes above this 25,988 break even, then you will have the you will incur losses. Capital required is 2.42, POP is 68.28. Max profit you could make is on the capital 9%, 21,603. Okay, so now let us see the different scenarios. Okay, so the first thing is markets stays below your short call strike. So that scenario is basically the market is stays below your short call strike, which is 25,700. So if it stays below 25,700, this is all profit only. Okay, so you'll make profit. So just once the profit reaches 70 to 80% of this total max profit, then you exit the trade. Okay, that's what you need to do. And close down early before any big event will wipe off your profits. Market falls slowly towards your short put strike. Okay, so put spread starts gaining value, but with no downside risk. So here, market is falling down towards your short put. So it's basically falling down. But yeah, here you have no downside risk. So total here capital, your profit only on the downside. So you'll make profits only, even if market is falling. So you need not do anything there. Also, you can just hold it as long as credit is greater than spread width, and yeah, so you can just if you want, you can roll down the call strike and add another short put spread. It's not needed. Also, you can just hold it, and it will make money for you. Okay, if you want, you can roll this further. In that scenario, the third scenario is market breaks above short call strike. Okay, so here. So here there is an applied unlimited upside risk. So short call is in danger. So you what you need to do is you buy a higher strike call, or you roll up a roll up short put spread, or you close and re-enter at higher strikes. So what you have done is you have shorted this call, right? So if market has broken this short call, right? So the scenario is market breaks the short call strike, and what you could do, right? So you close this position and enter another position. Market breaks the short call, you still have some leeway here. You can roll up this short call strike to 25,900 order. That you could do one thing. or you can just close this position and deploy another one that you could do. Okay. Yeah, and the last scenario is market breaks out sharply above your break-even point. So here there is a problem. So if market has moved up beyond this point, the break-even point, then you are in losses. So you need to cut your position immediately, and you can what you could do is you could take an opposite view. Your view was bearish here, right? So you could buy a call or some bull call spread or bull put spread you could deploy, or some call calendar call ratio spreads also you can put ratio spreads also you could deploy. Okay. So yeah, so that's what you have to do. So market breaks out sharply, large losses are possible, so you convert it into a broken wing butterfly on call side. Yeah, or call ratio spread, anything. Yeah, broken wing butterfly on the call side is also one of the you basically change your view to bullish and do whatever a bullish strategies are there, or you exit the trade. Examples of Nifty are selling 20,200 C, and you have sold 19,800 P and 19,600 P. So if market stays within 19,850 to 21, do nothing with the profits. If market falls to 19,700, right, then also you need not do anything. You'll make profit only because there is no downside risk. But if you want, you can roll down call to 20,000. Okay. If market falls rises to 20,300, there your sell your call leg is broken. Then you can yeah, basically change your view to and just buy 20,400. You can buy 20,400 to cap losses, or you could yeah, roll this put spread 19,800 P to 20,000 P. That also you could do. Or you take a bullish trade, basically you cut this position and take a bullish just buy a C, or buy put a bull call spread, bull put spread, or any bullish trade strategy you could deploy. Risk management tips. So always confirm credit is greater than put spread weight to ensure no downside risk. Main danger is in sharp rallies, so manage upside exposure quickly. Avoid entering before bullish events, earning heavy weeks, big economic policy announcements. So don't deploy this during this events, bullish events. Keep margin buffer for adjustments like adding calls or rolling positions. That's the reverse Jade lizard adjustment. So that could be done on a positional deployment. Thanks everyone. Have a nice day. Bye.